Hey there, it's Doug Shoemaker, your local loan officer here to help get you up to speed on the big changes happening in the real estate world. Now, today we're going to be diving into the National Association of Realtors, otherwise known as NAR. We're going to be getting into their settlement and breaking down what it actually might mean for you, the home buyer, when it comes to the possibility that you just might be paying your own buyer's agency commission. Now, with all the media coverage, I know it sounds like there's a lot, but don't worry, I've got some great options and a few examples that are going to help you navigate this a lot easier. So, for anybody that's not been living in real estate news and you aren't really familiar with what's going on, I'm going to go ahead and catch you up as quickly as I can. Now, for about the last 20 years or more that I've been in lending, the seller would actually pay a commission to the listing agent or the agent that's actually selling the house for the seller of the home. A listing agent is actually the person that helps the sellers with all the ins and outs of selling, like marketing or negotiating or going through all the legal contracts and such. Now, the listing agent in the past was paid a commission, and unless they or their team sold the home themselves, they would split that commission with a buyer's agent. Now, today, there are some changes to the buyer's agency commission that could make your transaction as a buyer considerably different, or it might be just the same as it was. A little confused yet? Well, hopefully, we're going to fix that pretty quickly today. So let's jump into the first option. Now, one way that you can structure the buyer's agency fee being paid on your behalf is by requesting that the seller cover a percentage or a set dollar amount of that buyer's agent's compensation. Now, honestly, this isn't all that different from asking the seller to pay for closing costs in the past. Now, you might have already seen this when sellers cover things like lender fees, title fees, or setting up the escrow account. While the new changes are scaring a whole lot of folks and seem like a really big shift in the industry, we believe that most home purchases are still going to look very similar to what you're used to, where the seller pays the buyer's agent's commission. And just so you know, asking sellers to help with closing costs or provide credits, it's pretty darn common. But it's also capped by something called interested party contributions. You may see IPC limits whenever you're seeing this referred to by others. Now, these limits are actually based on things like whether the home is going to be your primary residence or not, your loan type, such as conventional, FHA, VA, maybe rural development. Now, I've added a handy little chart down in the description that you can click on that's going to go over what the interested party contributions are for all these different loan types to help you. Now, one of the biggest questions that I've been getting is, can the buyer's agent fee be part of the interested party contributions? Now, the good news is it's not included in those limits. So a seller can actually contribute to your interested party contributions or maybe your closing costs, and they can also give you a credit for the buyer's agency fee on top of those IPC limits. Just remember though, if you're eyeing a super hot property in a really competitive market, asking the seller to cover that fee or your closing costs, it could make your offer less attractive compared to others. Now, that's why having a local real estate agent and lender that work together as a team in your corner is really key in this situation. Now, the second option is super flexible. If you were already putting down more money than what was actually required, you could adjust that down payment limit or just adjust the cash that you're bringing to closing. So if you've been planning to put down more than the minimum, maybe 6 to 10%, you could actually reduce that to the minimum of maybe 3 to 5% and use the rest to cover that buyer's agency fee. Now, this can make your offer stand out in a competitive market, especially if other buyers are asking the seller to foot the bill for the buyer's agency agreement and or the closing costs. Now, the next option is to negotiate the price. Then you can increase the contract price to include the buyer's agency fee. Now, as long as the house appraises for the increased amount, the seller can use that extra bit to cover that buyer's agency fee. And if there's a small gap between what the house appraises for and the fee, you could explore increasing the interest rate just enough to cover that difference. Let's say, for instance, you increased the price of the home enough that the buyer's agency fee could be a 3% fee. But when the appraisal comes back, it only allows enough room for 2.5. Well, that half percent difference could possibly be included in your interest rate in your loan. But only do this with a lender that you trust that will actually walk you through the long-term impacts of that rate increase. Now, we're talking about making sure that you're set up for success down the road 3 to 5 years, not just today. Now, option four is really the most straightforward. If you've got the funds available, you can simply pay the buyer's agency fee out of your pocket. So it's the cleanest offer that you could make to the seller, but this is only going to work for those who have enough to cover the down payment, closing costs, and the buyer's agency fee. Now, this last option is for a really specific group, and I wouldn't recommend it for most people. So, most states have state and local intergovernmental grant programs that might actually cover that buyer's agency fee for you. Now, they could actually cover some closing costs as well, but they often come with higher interest rates, additional fees, and they'll usually have requirements that you can't refinance that loan or sell the house for a 5 to 10 year period, or you might have to pay that money back. So you could miss very valuable refinance opportunities down the road. And with most economists projecting the next 18 to 24 months, we're probably going to see some really good refinance opportunities. This option might not be for everyone. So while it could work for people that need a little bit of extra help to become homeowners, it's definitely not a one size fits all. All right, now that we've actually gone over your options, let's take a look at how this actually plays out with the average home price in the St. Louis metro area. We're going to run some numbers and get a clearer picture of how each one of these strategies might impact your bottom line. Let's get to it. So let's kind of go ahead and get started. You'll see option one. This is the one I was talking about where it's just like it was in the past. You're going to work with your favorite agent. They're going to help you find the home you love, and the seller's agent is going to pay both the seller's agent's commission and your agent's commission. The next one here is, well, if you were considering putting 10% down on this option, what if you only put 7% down on this option and the 3% difference paid your buyer's agent? The third one here is, well, what if instead of offering them 255,000, which we know they'll take, what if we added the buyer's agent's commission to that agreed upon price and we went with the higher price? Well, that could work too. And then the last option here was, what if we did it for 255 and we just went ahead and paid that commission out of our pocket? So let's go ahead and take a look at the things that are the same. Well, all of these are going to be based off of a 30-year fixed rate. I did all of these with no second mortgage or government grant program. There's no down payment assistance or anything like that. I prepared all of these at 6.125% because that's the national average as of today. And you'll see I only did these based on conventional loans. That way, we don't have loan types and different types of mortgage insurance clouding the comparison of these different options for you. So 6.125 is the national average today. The APR difference, the reason that is there is because this here only discloses the rate at which your loan is going to accrue interest on a daily basis. If we were charging you a bunch of discount points or something like that, how would you know? Like, what is the better deal? Well, if somebody is charging you 6.125 as a rate, but they've got a 6.75 APR, that means that there's a lot of fees baked into there because the interest rate discloses the daily rate of interest that your loan is going to accrue interest at. The APR takes that in consideration, but it also takes into consideration something called unearned finance charges. If we were charging you these discount points, that would be calculated into your APR. So if a lender wanted to get tricky because they knew all you were looking at was the interest rate, well, they might give you a lower interest rate, but charge you 2 or 3% in discount points because they know you're not looking at that. Well, you would know that difference because if they had a lower interest rate, but their APR was higher, that means that they're charging more money. So you always want to look at the interest rate and the APR. Now, again, I don't show any discount points here because in this environment where it's a flat or a decreasing rate environment, generally speaking, I don't advise paying those points. And the main reason I say that is when you buy discount points, when you're buying down your interest rate, it usually takes somewhere between 3 and 5 years before the monthly interest savings equals the amount that you paid to get that lower rate. So if it's going to take you 3 to 5 years to break even, and most respected real estate economists today say you're going to be refinancing within maybe 18 to 24 months, you will not have even gotten close to paying yourself back for the money that you paid to get that lower rate in the first place. So right now generally is not a good time to pay points. Now, don't get me wrong. If you've got challenged credit scores or you don't have any credit, if there's some reasons you're having to pay some discount points, that's different. But you generally don't want to pay discount points right now to buy down your rate because you're probably refinancing in the next 18 to 24 months. Now, the next thing you see is that I prepared all of these based off of a fixed rate. You see that the mortgage insurance does change on here. Now, the main reason being, remember, this option here was one where you're just doing a 90% loan, the seller's paying all the real estate agent's commission. On this one here, we raised your loan to value from 90% because we did a lower down payment. So when your loan to value, meaning your loan versus the value of the home, when it goes up, the more mortgage insurance you're going to pay. So that's why it goes from 88 to that 130. And you see in this case, it goes from $91 to $88 whenever you're paying all of that buyer's agency commission out of your pocket. When you're not raising the loan to value, the mortgage insurance would stay the same. Next one here is annual principal and interest. Now, you see your total monthly payment across here. Principal and interest does not include taxes and insurance. So on your total monthly payment, you can kind of see that whether the agent's paying or the seller is paying all that commission for you, or you're paying it all yourself, if you're not really changing the loan, your payment's the same. So there's not a lot of fluctuation from one payment to another on here, which is the other thing I really wanted to point out because it's not like you're gaining or losing a whole ton with whichever of these options that you choose. They're all very similar. Now, right down here is your cash to close, and you see that they're also very similar, with the exception if you're paying that commission completely out of your pocket, this is what it would go to here. Hey, I hope you found this information helpful. And if you did, please like and subscribe and make sure you share this video with anybody you know that's considering buying or refinancing here in the near future. We sure would appreciate it. Thanks so much, and I hope you have a great week.